If an economy collapses but nobody's paying attention, does it count? You came here for the truth, so let me unveil that for you. I've got a very serious video for you today. We're going to look at a few aspects of the economy and the markets that I think you should be aware of. The first thing is the warnings. These warnings are coming from every single corner. I want to show you some of those. We are going to look at the Fed for number two. That's the most important thing, I think, for a lot of investors today. I'm going to show you what you need to know. And number three is commodities, because really, this is something that was on the move upward, and that's part of the inflation trend. Has anything changed? Let's get into all that right away. Let's start with this one right here. I posted about this on my Instagram and Twitter and Facebook and all that, but I want to show you here in depth. Record skew index shows nagging investor nerves on US stocks rally. Fear edges ahead of greed as fund managers snap up insurance against market shocks. So this is the skew index, and I'm going to show you that in a second in a chart form, but let's talk about this really quickly. I've got several others to show you today, okay? But let's look at this first from this Financial Times article. Mounting investor nerves over the strength of the US stock market rally has sparked a dash to buy insurance against a spike of turbulence, lifting a popular financial fear gauge to a record high. The S&P 500 climbed more than 16%. So you saw basically this huge rise up in the S&P 500, the NASDAQ, and now you can see what has happened with the Dow Jones that has started to come up and so on. And as a result, it gets a little bit too ahead of itself. And so investors come in to maybe realize that there's a bigger chance of a pullback coming in. They're not talking about a crash. They're not talking about this being devastating in this manner. But when you see this going in the direction that it has, it simply signals that the direction is about to turn. At least usually it does. However, given lofty valuations and the shakeups that can erupt over the thinly traded summer months, some investors are now buying insurance against the sharp stock market declines. As a result, the skew index, which measures the difference between the cost of derivatives that protect against big market drops on one side and the right to benefit from a rally on the other, has hit record highs. And let's look at that. There is nothing even close to what we are seeing right now today. Going back to 1990, all the way through until today. Now, this has been accelerating, of course, after the financial crisis, and it's just been up and up and up. And now we are looking at this being at a point at which we have never been before. And then you go to the opposite end of the spectrum, something that's supposed to be in line with the skew index, you would think. But why is Wall Street's fear gauge so low? Investors urged to have eyes wide open about what is coming next. So what are we talking about here? The VIX. The VIX Index is something that's supposed to show the volatility, but in the S&P 500, it's not really volatile at all. It simply moves up and up and up, right? After inflation fears shocked investors in the first few months of 2021, markets have switched into a different mode, a deep slumber. The VIX is just showing you right here, and I'll give you the chart in a second, at around 15. Now that is not the lowest it's ever been, but certainly it's a big disparity in what we are seeing with other indicators like the skew. So just to give you a quick insight on that right here, you can see the VIX and what has happened. This is basically going back from late April up until now. And as far as I'm concerned, it has been quite low, that's for sure. And that is something that a lot of traders pay attention to. You as an individual and the economy as a whole, not necessarily that important, but something that traders are watching. Okay, so that's the VIX index. Then we look at this. Broad market liquidity, the ease with investors can buy or sell a security without affecting its price, has been in a downward spiral for more than 10 years. That's never a good sign. You want more liquidity. But that isn't the case. And despite what's happening with all the central banks, not just the Fed, but all the central banks pumping money into the system left, right, and center, despite all of the introduction of these new schemes that have been put into place, making it much easier to invest, you look at record retail participation, all of that, you still have liquidity that's been declining over the past decade or so. Look, for example, at what has happened to trading in futures contracts in the S&P 500 index, typically the world's most liquid equity index futures. Over the past decade, their liquidity as measured by market depth has collapsed by around 90%. This pattern is repeated across asset classes and regions. You can go into that further. I'm just trying to show you that there are so many different things that are firing off all at one point. Day of reckoning is coming for high-flying tech stocks. Now, this is Wells Fargo saying this. Doesn't really matter, but the point here is what they put at this point in the quote. The premium that you're paying is still exceptionally high. We believe the premium has got to compress. 2, we think that the next 25 basis point move in the 10-year Treasury note yield is up, not down. So the bond market usually signals what will happen. The stock market is kind of doing its own thing. So many investors like to look at the bond market as a better gauge of what's happening in the economy, and the general, financial analysts, let's say, are always keeping a watchful eye. Now, all of that, I wanted to cover just one more. This is from Husband Funds, okay? Really quickly. In my view, much of the cartoonish behavior that we observe in various markets and asset classes is directly or indirectly Fed-induced. You know that, I know that, but let's go on. Explosive growth in monetary hot potatoes, coupled with years of zero interest rates, have fueled an increasingly reckless speculative appetite for alternatives that might escape or profit from the Fed's unrestrained activism and financial repression. If we insist on Japan-style monetary dogma, we should be fully prepared for Japan-style outcomes. What's he talking about? I think it's pretty clear what you do when you intervene at such a level, the outcome of which is never good. Number 1, major warning signals are flashing right now. Number 2, the Fed has publicly suggested that they are going to reduce the amount of support that they are giving to these different markets. Number 3, markets themselves. They need reassurance that the Federal Reserve is going to be there, that they're going to ease, that they're going to continue what they've been doing in order for the markets to have their bull run continue. I would watch very closely on what the FOMC has been doing all along, of course, and into the near future. Watch their next few statements and any policy that's being changed, adjusted, or any of their forward guidance coming up. Obviously, I bring you the Fed information that you need to know so you don't have to sit through these hour or 2 long conferences that they are just a headache and a half. But anyway, this right here is an article that essentially gets into a few of the different quotes from the different people around the Fed. This is Robert Kaplan. We'll be far healthier sooner rather than later to begin tapering, adding that the economy was likely to meet the, quote, substantial further progress, you heard that line a million times, threshold that the Fed has set towards recovering faster than he expected. These purchases are very adept at stimulating demand, but we've got plenty of demand. Our problem is supply, and these purchases are not very effective when you've got a supply issue. And so that's a factor that tells me that as soon as we can get to substantial further progress, we'll be healthier to wean off of these purchases. Interesting point, right? Now take a look at this. Waller, another, I think he's the governor, one of the governors of the Fed, we are now in a different phase of economic policy, and so it's appropriate to start thinking about pulling back on some of the stimulus, beginning with how and when to start tapering the Fed's monthly purchases from $40 billion in mortgage-backed securities and $80 billion in treasuries. And look at the quote, right now the housing markets are on fire. They don't need any other unnecessary support, and it's an easy sell to the public. What have I been saying all along? The mortgage-backed securities, you don't need it. Look at what's happening with the housing market. You're still buying $40 billion a month. It's insane, but they're still doing it, and we'll see what happens. I mean, they've been doing this since the financial crisis. The market didn't need that. Maybe, up until 2011, you could have argued it needed it. I don't agree with that. But after that point, it's really, really insane what they've been doing. Now look at commodities. You could see this, obviously a very popular one. Oil prices jumped to multi-year highs after OPEC Plus talks yield no production deal. They wanted this, of course, to get that price down. This is oil. Look at that chart. 76.68 as I record this on the WTI. I also wanted to note, and I know that people don't want me to talk about this, but you can see statistically, I mean, look at the indicators. There are many that triggered right around this point that would have been an excellent opportunity to buy in. This is, anywhere between the May 24th to, possibly around the 27th. Any of these moments in here, it was kind of an easy buy for those paying attention. I know some people don't want to hear about it, so we'll just move on. Taking a look at commodities, you could see how well they've done year to date. Crude oil, 58%. You just go down here, gasoline, heating oil, all these different things. Looking at gold and silver, of course, the most highly manipulated assets on the face of the earth. There's no doubt about it. It has been proven time and time again. But you look at what's going on with agriculture and, in this case here, lumber, minus 43%. This is on the month, in a month, okay? And it's really, really down from its peak. If you look at the price currently at $756, this was at $1,700. But there are others that are still pushing higher. So it's not necessarily, everything moving up or down together. So keep an eye on that, absolutely. Now, who is benefiting from all of this Federal Reserve intervention? Who's actually benefiting from the commodities rising? Who's benefiting from all these actions? Follow the money, they say. Well, concentration of stock ownership by wealth bracket. Did I need to show you the chart? The top 1%, 40.3%. Okay, and you look at the bottom 80, 6.8%. And if you were to separate that even further, looking at the top 0.1%, it gets even more exaggerated, all right? Now, talked about gold, showed you the performance. However, gold regains shine after central bank buying drops to a decade low. So previously, throughout 2020, the governments weren't necessarily buying gold. They were kind of just worrying about their economies, dealing with the whole issue. But now they've been getting back on. Banks, including Thailand and Serbia, have been raising their reserves. So you see that a lot. Now, speaking of those who have been doing a lot of buying, doing a lot of spending, you could see this chart right here out of Bloomberg just showing you the mega yachts and where they are positioned today. And it happens to be the number one place is Greece. Greece is the one where all those mega yachts seem to be, but you can also see it around Italy, in the Adriatic, and you just look around that and just shows you where the money clearly is. Now, I wanted to give you a little bit of quick just forewarning. Here are some of the events to watch this week. The Reserve Bank of Australia, are they going to keep rates where they are? Are they going to touch their QE? We'll see what happens. FOMC minutes are on Wednesday. We'll get some more details there. The G20 and the central bankers are meeting in Venice. That will be interesting because they'll come back and they'll kind of all unify on their policies. And China's PPI and CPI coming out. So a lot of information. I don't think I have any time to get into any of these. This is just showing you the labor shortages creating a supply bottleneck, resulting in price increases at a rate we haven't seen since 1951. Just to give you, a description of what's been happening here as it relates to history. Households, businesses are brimming with confidence and cash in Canada right now today, yet there's really, truly no reason for that in the way that they are perceived, because if you take away what's happening with real estate, things aren't looking that good in the economy, but whatever. This happens to be China's service PMI. It has come down here. This is the weakest level since back in early 2020, but we'll see if this is just another blip, because we've had these dips before. I think it's important to watch all of that. And I don't have time to get into all of this, certainly at all. This is Zoltan, who is the expert on the repo operations. If you want to know what's going on, anything to do with the repo operations, read this Wall Street Journal article. The links will be in the description under the sources. If you have not, I don't know why, but if you haven't, you've got to join the Insiders. It's totally free. And what I do is basically 5 times a week, I email you the video of the day. That allows me to get to you directly without any sort of intervention, without any blocking or all these different shadow banning and things that they do. Get on the Insiders, put your email in there. And even if you don't want to see the emails at all, it's just the video of the day. But if you don't want to even see them, you just delete them, ignore them. But at least if we lose connection, I have a way to get to you. Sign up by clicking on this card up here, or you can simply just go to themoneygps.com. If you haven't already, hit that thumbs up button, subscribe to the channel, hit that notification bell, and last but not least, if you haven't seen this video, you got to watch it. Click it, and I'll see you there.